So, you want to own a solar farm. Free fuel, falling equipment costs, a technology everyone agrees is the future of electricity generation. Here's the part nobody tells you. The panels are almost never the reason a solar farm succeeds or fails. The single biggest determinant of whether your project ever generates a dollar of revenue is a bureaucratic process most people have never heard of, one that now kills more solar projects than bad weather, bad financing, or bad engineering combined. That's not a contradiction. That's the whole business, and once you understand which part of this industry actually decides who wins and who loses, you'll never look at a field of solar panels the same way again. Let's start with what it actually costs to build one, because the range depends heavily on how you're counting. Utility-scale solar construction runs somewhere between 85 cents and $1.60 per watt of installed capacity, not including land. A 20-megawatt project, a reasonably typical mid-size farm, lands you somewhere between $20 and $60 million depending on equipment choices, interconnection costs, and how complicated the site is. Land itself adds another layer, typically $12,000 to $15,000 an acre on average nationally, though it can run as low as $3,500 or as high as $80,000 depending on the state. A single megawatt of solar needs somewhere between 5 and 10 acres, so a 20-megawatt farm is tying up a genuinely large piece of land for the entire life of the project. Most developers don't actually buy that land outright. They lease it, typically from farmers or ranchers who keep ownership of the underlying property while collecting a steady annual payment, somewhere between $300 and $4,000 an acre a year, depending on the region and the quality of the site. For a landowner, this can be dramatically more reliable income than working the same acreage for crops or grazing, since it doesn't depend on weather, commodity prices, or a single growing season. For the developer, leasing rather than buying keeps upfront capital lower and avoids tying the company's balance sheet to land values that might move against them. But it also means the developer's entire multi-decade project sits on land they don't own, governed by a lease agreement that has to survive every twist in financing, permitting, and construction that follows. Permitting alone can take 3 to 5 years before a single panel goes into the ground, layering environmental reviews, zoning approvals, and local community meetings on top of the technical engineering work. None of that time is optional, and none of it is particularly predictable, since it depends on local politics and regulatory bandwidth as much as anything about the project itself. Now, where does the revenue actually come from? Almost entirely from a power purchase agreement, a long-term contract locking in a price per megawatt hour with a utility or large corporate buyer, typically running 10 to 20 years. This is the mechanism that converts solar power, which only exists during daylight hours and varies with cloud cover, into something a bank will actually lend billions of dollars against. Without a signed PPA, no financier writes a check for a utility-scale solar project. National PPA pricing has fallen substantially over the past decade, with most markets now seeing levelized rates of $50 per megawatt hour or less. The other number that determines everything is the levelized cost of energy, the average cost per unit of electricity the project needs to generate over its full lifetime just to break even. Using standard financing assumptions, roughly 70% debt at typical interest rates, the effective levelized cost for a modern utility-scale project runs somewhere between $35 and $45 per megawatt hour. The gap between that number and your PPA price is where every dollar of profit in this business actually lives. Layered on top of both of those numbers is a third factor that has shaped nearly every utility-scale solar project built in the United States over the past decade: the federal investment tax credit. For years, developers could claim a tax credit worth 30% of a project's total capital cost, a subsidy substantial enough that entire financing structures, entire investor return models were built assuming it would be there. Projects get financed years before they're built, and the tax credit assumptions baked into those financing models don't get revisited just because policy shifts in Washington. A project modeled around a 30% credit that later sees that credit reduced, delayed, or restructured can see its entire return profile change dramatically through no fault of the developer, the land, or the panels themselves. This is the kind of risk that sits quietly underneath the entire industry's financing structure, rarely discussed publicly, but very much present in every model a solar developer builds before ever breaking ground. Here's what makes solar economics genuinely attractive once a project is actually up and running. Annual operating expenses are remarkably low, typically $18,000 to $32,000 per megawatt a year, covering panel cleaning, vegetation management, and equipment monitoring. There's no fuel to buy, ever. With financing in place and reasonable market conditions, solar farm returns of 10 to 15% annually are genuinely achievable, and the asset can keep generating positive cash flow for 25 to 30 years, sometimes well beyond its original design life. On paper, this is one of the cleanest, most predictable infrastructure investments available anywhere in the economy. Compare that operating simplicity to almost anything else in this category. There's no fuel supply chain to manage, no combustion equipment to service, no emissions monitoring of the kind a gas or coal plant requires. Panels degrade slowly and predictably, typically losing well under 0.5% of output capacity each year, which means the production forecast a lender relies on when financing the project barely changes over its entire operating life. For an investor comparing infrastructure assets, that predictability is genuinely rare, and it's a large part of why pension funds and long-duration infrastructure investors have poured so much capital into this sector over the past decade. So if the operating economics are this favorable, why do so many solar projects never get built at all? Here's the part of this industry that almost nobody outside of it understands, and it's the single factor that has quietly become the dominant risk in the entire business. Before a solar farm can deliver a single watt of power to anyone, the utility or grid operator has to study whether the local transmission system can actually handle it. That study process, and the line of projects waiting for it, is called the interconnection queue, and it has become a genuine crisis. Between 2021 and 2024 alone, the total capacity waiting in America's interconnection queues ballooned from roughly 1,400 gigawatts to more than 2,000 gigawatts, with average wait times stretching to 4 years. By 2025, that queue had grown past 2,600 gigawatts, with the median time to actually reach commercial operation approaching 5 years. In some regions, companies seeking new grid connections have been quoted wait times of up to 12 years, and the completion rate for projects that enter this queue is genuinely brutal. Research covering projects that entered queues between 2000 and 2018 found that only about 20% ever made it to completion. More recent data is even worse, with withdrawal rates for projects entering the queue in the current environment approaching 80%. According to one industry analysis, roughly 90% of projects currently sitting in these queues are projected to never come online within the next 3 years at all. The mechanics of why this happens are almost bureaucratic in their cruelty. Over 90% of interconnection applications contain errors requiring revision, and each resubmission can add 6 to 8 weeks to the timeline. Projects get grouped into cluster studies, batches of applications studied together on the same timeline, which means if a single other project in your cluster has a problem, your project's timeline can be delayed right along with it, through no fault of your own. And even after a project clears the queue and gets approval, if the nearest substation needs an upgrade, transformer lead times for new substation equipment have stretched to 18 to 24 months in many parts of the country, adding years to a project that has already, on paper, been approved. The regional variation in all of this is significant, and it isn't random. Grid operators like NYISO, PJM, and ISO-NE see interconnection agreement suspension rates ranging from 46 to 79%, meaning a huge share of projects that make it deep into the study process still get suspended before ever reaching construction. ERCOT, CAISO, and MISO see suspension rates closer to 20%, still substantial, but a very different risk profile depending entirely on which regional grid your project happens to sit inside. A developer choosing where to site a project isn't just choosing for sunlight and land price anymore. They're choosing a regulatory risk profile that can differ by a factor of 3 or 4, depending purely on which grid operator happens to have jurisdiction over that particular patch of land. Here's the part that actually destroys project economics. And it isn't just the delay itself, it's what the delay does to everything else. A solar project can have perfect land, a signed lease, a completed environmental review, and committed investor capital, and still sit idle for years, waiting purely on a grid study that has nothing to do with the quality of the project itself. Every year of delay is a year of carrying costs, land lease payments, insurance, legal fees, property taxes on land that's generating nothing yet, accruing with zero revenue coming in. Financing costs compound the problem further. Interest on construction loans or on the capital tied up waiting for permission to build doesn't pause just because a grid study is taking longer than expected. A project modeled to start generating revenue within 18 months of financial close can instead sit for 3, 4, sometimes 5 additional years, with every one of those years adding real compounding costs cost to a project that, on paper, was supposed to already be profitable by now. Meanwhile, the PPA that made the project financeable in the first place was often signed years earlier, at a price that assumed a construction timeline the interconnection queue has since made impossible to hit. Material costs, interest rates, and equipment prices can all move significantly during a 4 or 5 year wait, while the locked-in PPA price stays exactly where it was the day it was signed. Developers describe this dynamic bluntly. The interconnection queue is no longer a functioning process. In practice, for a huge share of American solar projects, it has become the primary cause of project failure. Full stop, more decisive than financing, weather, or engineering combined. Some of the failure is self-inflicted at the margins too. Speculative applications, developers submitting for grid positions on land they haven't fully secured, on projects that may never actually get built, have historically clogged the queue further, forcing grid operators to study capacity that was never going to materialize into a real project in the first place. Regulators have started responding. The Federal Energy Regulatory Commission issued Order 2023 specifically to address these delays, introducing measures like readiness deposits, meant to discourage speculative applications, and cluster study reforms meant to process groups of projects more efficiently. Whether those reforms meaningfully shorten the queue remains to be seen, and developers on the ground report that regional implementation varies enormously, with some grid operators moving faster than others to actually apply the new rules. Now compare that systemic risk to how one company has managed to keep building at massive scale despite it. NextEra Energy Resources has become the world's largest wind and solar developer, and the structure underneath that success explains a great deal about how to survive an industry this exposed to a single point of bureaucratic failure. NextEra operates what analysts describe as a dual-engine model. Florida Power and Light, its regulated utility arm, generates stable, highly predictable earnings, serving more than 12 million customer accounts, functioning as a financial anchor for the entire parent company. NextEra Energy Resources, the renewable development arm, then uses that stability to fund aggressive, long-horizon renewable investment without threatening the company's near-term earnings if any individual project gets stuck in an interconnection queue for years. That structure lets NextEra do something most standalone solar developers simply cannot. It can absorb individual project delays without those delays threatening the company's survival, because no single project, however large, represents an existential risk to a business anchored by a regulated utility generating billions of dollars in predictable cash flow every year regardless of what's happening in any particular interconnection queue. NextEra's renewable backlog, the pipeline of projects it's actively developing, has grown to more than 30 gigawatts, and management explicitly treats that backlog as a strategic asset in its own right. A deep enough pipeline that delays on any individual project simply mean other projects in the queue move forward instead, rather than the entire growth strategy stalling out. The company's revenue grew from roughly $17.1 billion in 2021 to about $27 billion in 2025, and NextEra has increased its dividend for 29 consecutive years, a streak that has survived multiple periods of exactly the kind of interconnection gridlock that has stalled or killed projects across the rest of the industry. Florida Power and Light itself generates roughly $18 billion in annual revenue on its own, with net income climbing from around $2.57 billion in 2019 to approximately $5 billion by 2025, entirely independent of how quickly any particular solar project clears a grid study somewhere in the country. That's the real function of the regulated utility inside this structure. It isn't just a source of cash, it's a source of cash that has nothing whatsoever to do with the interconnection queue, which means the parent company's quarterly results and its ability to keep raising capital for the next round of renewable projects never depend entirely on the same bureaucratic process that determines whether any single solar farm actually gets built on schedule. The difference between NextEra and the roughly 80% of solar projects that never make it out of the interconnection queue wasn't better engineering or cheaper panels. Both are subject to the exact same grid bottleneck, the same cluster study delays, the same multi-year waits. The difference was financial structure. A standalone developer with 1 or 2 large projects tied up in a 5-year interconnection queue has no revenue coming in and mounting carrying costs. With the entire company's survival riding on projects it cannot control the timeline of. NextEra, with a regulated utility generating predictable cash flow and a backlog deep enough that individual project delays simply reshuffle the sequence rather than threatening the whole enterprise, can afford to wait out exactly the same bureaucratic gridlock that bankrupts smaller, more concentrated developers. That brings us to the structural risk sitting underneath this entire industry. And it isn't panel technology, financing costs, or even the price of electricity, real as those factors are. It's concentration risk against a bottleneck nobody in the industry actually controls, layered against a subsidy structure that can shift underneath a project's financing model years after the deal was signed. A wind farm, which we've covered on this channel before, faces a version of this same problem, a multi-year gap between signing a fixed-price contract and finishing construction, during which costs can move against the project while the locked-in price stays fixed. Solar faces an even more acute version of it because the gating factor usually isn't the construction itself, which can move relatively quickly once permits and interconnection are secured. It's the years spent simply waiting in line for permission to connect to a grid that was never built to handle this volume of new applications in the first place. The panels can be manufactured, shipped, and installed in months. The wait to actually turn them on can run 5 to 10 times longer than the construction itself. A developer with their entire business riding on 1 or 2 large projects, clearing the interconnection queue on schedule, is betting the company's survival on a bureaucratic process running at a predictable pace, when the data clearly shows that pace has become genuinely unpredictable, frequently taking years longer than originally planned, with completion rates that have fallen sharply even in just the past several years. Zoom out across the industry and the pattern becomes obvious. The solar developers who survive across full market cycles are almost never the ones with the single biggest, most ambitious individual project. They're the ones with either a diversified pipeline deep enough that any one project's queue delay doesn't threaten the whole business, or a financial backstop, like a regulated utility, stable enough to absorb years of uncertainty on any individual project without an existential crisis. The developers who fail are almost always the ones who finance themselves as though the interconnection queue would behave predictably, discovering too late that a project with perfect land, perfect financing, and a perfectly signed PPA can still sit generating zero revenue for years. Waiting on a grid study process, the company has no ability to accelerate. This is why so much of the industry has consolidated over the past several years, with smaller single project developers increasingly selling their development stage assets to larger platforms before construction even begins, rather than trying to carry a stalled project through years of uncertain queue timing on their own. A small developer with one promising site and a signed lease often can't survive the multi-year wait long enough to actually build anything, so they sell the rights to a company with a large enough balance sheet to absorb that wait, taking a smaller, earlier payout in exchange for offloading a risk they were never actually equipped to carry. That consolidation trend is itself a symptom of the underlying problem. An industry where individual projects routinely take 5 to 10 years longer than planned to reach construction is an industry that structurally favors companies large enough to treat any single project's fate as a rounding error rather than an existential question. So does owning a solar farm actually work as a business? The honest answer depends almost entirely on how exposed you are to a single point of bureaucratic failure that has nothing to do with how well you built or financed the project itself. In the optimistic version, you either diversify across a deep enough pipeline of projects that individual interconnection delays simply reshuffle your timeline rather than threatening your survival, or you're backed by a stable enough balance sheet to absorb years of uncertainty on any single project, the way NextEra's regulated utility arm has quietly funded one of the largest renewable build-outs in history. In the realistic bad version, your company's fate rides on 1 or 2 large projects, clearing a queue that, industry-wide, now sees roughly 80% of entrants withdraw before ever generating a watt of power. And by the time you discover your project is one of the ones that stalls, years of carrying costs have already accumulated with nothing to show for them. Neither outcome has much to do with how much sunlight actually falls on your land. A solar farm was never really a bet on sunlight or panel technology. It's a bet on whether your company can survive the multi-year bureaucratic gauntlet standing between a signed lease and an operating power plant, a gauntlet that, for a growing share of the industry, never actually ends. The panels themselves have gotten cheaper every single year for over a decade. The engineering has gotten more efficient. The financing markets have grown deep enough that capital, in normal circumstances, is rarely the constraint it once was. None of that progress moves the needle on the one bottleneck that actually decides most projects' fate: a grid built decades ago for a much smaller number of much larger power plants, now being asked to process an application volume it was never designed for. Until that bottleneck project genuinely clears, and there's little evidence it will anytime soon, the real skill in this business isn't building a better solar farm. It's building a company structured to survive not knowing for years at a time whether any individual project will ever get to turn on at all.